In algorithmic trading, time is measured in milliseconds and risk is measured in millions. But on August 1st, 2012, the financial world witnessed how a single software deployment error could vaporize a Wall Street titan in less than an hour. This is not a story about a flawed trading strategy or a sudden market crash. This is the story of Knight Capital Group and how a forgotten 10-year-old piece of dead code woke up to execute the most expensive, catastrophic loop in the history of quantitative finance. At its peak, the algorithm lost $10 million every single minute. Here is the engineering breakdown of the Knight Capital disaster. Knight Capital Group stood at the heart of the American stock market in 2012. At its height, the firm handled nearly 17% of all New York Stock Exchange trades and 16.9% of NASDAQ volume, more than any other market maker in the country. Every day, about 1 out of every 6 shares traded on these exchanges passed through Knight's systems. Their business depended on providing constant liquidity, matching millions of buy and sell orders for both retail investors and large institutions. This model generated $1.4 billion in annual revenue and supported a workforce of around 1,400 employees. Knight's influence extended across hundreds of listed stocks, making it a key stabilizer for the entire market. When a firm of this size and reach suffers even a minor technical issue, the effects ripple far beyond its own balance sheet. In a world where milliseconds separate profit from loss, the reliability of Knight's automated trading infrastructure was not just a matter of internal discipline, it was a matter of market stability itself. Subscribe for more true stories where technology and risk collide. August 1st, 2012 brought a hard deadline for every major trading firm on Wall Street. The New York Stock Exchange's retail liquidity program went live that morning, promising new revenue for market makers who could adapt their systems fast enough. At Knight Capital, engineers worked through the night to update SMARS, their core order routing engine, to meet the retail liquidity program's strict requirements. The pressure was intense, missed the launch, and Knight risked losing a critical share of retail trading flow to faster rivals. In the rush to deploy, a hidden hazard lay dormant. 9 years earlier, a developer had written a test algorithm called PowerPeg, code meant to stress the system by buying at the ask and selling at the bid in an endless loop. The routine was retired, but it was never fully removed from the codebase. Instead, it lingered in the production binary, shielded only by a feature flag called SMARS enabled. Over time, that flag was quietly repurposed. What once controlled PowerPeg now toggled the new retail liquidity program logic. On the morning of the rollout, 7 of Knight's 8 SMARS servers received the updated binary. Server 8 did not. No automated check flagged the omission, and with the clock ticking towards the 9:30 in the morning market open, the team pressed ahead. This intersection of business urgency and brittle engineering set the stage for disaster. The story that followed was not about a bad market bet, but about how a single unchecked flag, a forgotten chunk of legacy code, and a missed deployment step could combine to threaten the stability of the entire U.S. equity market. Subscribe for more true stories where technology and risk collide. At exactly 9:30 a.m. Eastern Time, the operations engineer entered a shell command, SMARS_CTL-set SMARS_enabled equals true. Across Knight Capital's trading floor, the moment passed without ceremony. But inside the company's 8-server SMARS cluster, the consequences split instantly. On 7 servers, the freshly deployed binary responded with the intended retail liquidity program logic, ready to route retail orders as the new market rules demanded. On server 8, untouched by the overnight update, the same flag pointed to a forgotten path, one that led straight into the dormant PowerPeg routine from 2003. Logs captured the divergence in real time. For servers 1 through 7, SMARS_enabled equals true meant business as usual, orders routed, spreads captured, rebates accrued. But server 8, running the legacy binary, interpreted the flag as a green light for PowerPeg's infinite loop. In milliseconds, it began firing buy orders at the ask and sell orders at the bid, disregarding price, position, or risk. There were no internal throttles, no loss limits, no guardrails. The loop simply hammered the exchange, symbol by symbol, as fast as the network could handle. Within seconds, the order flow spiked far beyond anything the team had seen. What should have been a coordinated rollout became a split-brain disaster. The manual deployment process, 1 engineer, 8 servers, no automated verification, left the system exposed to a single missed copy. The feature flag, repurposed over years of fast-moving code changes, now meant 2 different things in production at the same time. As the clock ticked past 9:30 and 1 second a.m. Eastern Time, the firm's risk profile changed in an instant. The operations engineer, watching the shell logs scroll, had no reason to suspect that one server was now running an obsolete trading algorithm at full tilt. The first seconds of chaos had begun, not with a market shock, but with a silent, invisible fork in the code. Subscribe for more true stories where technology and risk collide. Alarms erupted across Knight Capital's network as soon as the opening bell rang. Within moments, the SMARS system began to drown in its own output. Thousands of orders per second, each one a buy at the ask or a sell at the bid, sent without regard for price or position. The firm's monitoring dashboards, designed to flag unusual activity, instead became a wall of red. CPU and order rate alerts stacked on top of each other. Engineers' inboxes filled with error messages and system warnings, each more urgent than the last. In the control room, on-call staff scrambled to pinpoint the source. But with every second, the volume of rogue trades multiplied, overwhelming both the monitoring tools and the people trying to use them. Internal logs captured a torrent of activity. Email threads from that morning show engineers frantically messaging that orders were exploding and that they could not locate the source. The dashboard crashed under the alert load, making it impossible to isolate which of the 8 servers had gone rogue. As losses climbed past $100 million, Knight's senior tech lead ordered an emergency rollback. At 9:45, a script was launched to revert servers 1 through 7 to their previous binaries. But in the chaos, the rollback had a devastating side effect. It reactivated the same legacy PowerPeg code on those servers, instantly multiplying the number of nodes running the faulty logic. Instead of containing the disaster, the rollback poured fuel on the fire, sending the loss curve vertical. By the time the team realized the rollback had backfired, the order flood had reached its peak. Tens of thousands of trades per second, $10 million lost every minute, and no clear way to halt the cascade. The firm's reputation and its survival now hung by a thread. Subscribe for more true stories where technology and risk collide. At 10:05 a.m., the crisis reached its breaking point. The system operations manager, acting on direct orders from Knight's leadership, executed the manual kill switch, severing server 8's connection to the exchange gateway. In an instant, the torrent of orders ceased. For the first time in 45 minutes, no new buy-high, sell-low trades hit the market. The numbers left behind told the story in stark relief. Nearly 4 million erroneous orders, about 397 million shares traded, and a loss that would total $440 million, wiping out 3/4 of Knight's market value before noon. The scale was almost incomprehensible. In less than an hour, Knight's automated systems had generated more trades than most firms process in a month. The peak loss rate hit $10 million per minute. The firm's dashboards, designed for normal volatility, were useless now. Metrics spiked off the charts, and internal controls offered no relief. With every passing second, the company's survival slipped further from reach. As the dust settled, Knight's executive team scrambled to contain the fallout. Trading was suspended. Phone lines lit up as the board convened an emergency session. By August 6th, just 5 days after the incident, a $400 million rescue package was cobbled together by a consortium of rival firms and private investors. In exchange for a lifeline, these backers demanded a 73% ownership stake, effectively ending Knight's independence. There was no hiding from the consequences. The firm's collapse was not the result of a bad bet or a sudden market event, but the direct outcome of engineering shortcuts. Dead code left in production, manual deployments without verification, the absence of a true kill switch, and risk controls that failed when they were needed most. For every trading operation that relies on automation, the Knight Capital disaster stands as a warning. Code must be purged, deployments must be automated, emergency shutdowns must be tested, and risk throttles must be built into every layer. Subscribe for more true stories where technology and risk collide. Today, trillions move at algorithmic speed, but one dormant code path, one missed deployment, can still trigger systemic chaos. Knight's collapse proved that engineering rigor, code purges, automated rollouts, kill switches, and risk throttles aren't optional. In markets ruled by software, every safeguard is critical. Subscribe for more stories that decode the risks.